March 10, 2021, became the day the financial world learned that a single family office could erase more than $20 billion in value in less than a week, sending shockwaves through Wall Street and forcing regulators to rewrite the rulebook on hidden leverage. Archegos Capital Management was the brainchild of Bill H. Wang, a Korean-American trader who had already made a name for himself at the hedge fund Tiger Asia, where he survived a high-profile insider trading scandal and turned a modest seed capital into a multi-billion-dollar empire. When H. Wang launched Archegos in 2013, he did so as a family office, a private investment vehicle designed to manage his personal wealth and that of a select circle of friends and relatives. The structure gave him a veil of secrecy. Family offices are exempt from many of the reporting requirements that constrain hedge funds, allowing them to move massive amounts of capital without the scrutiny of the Securities and Exchange Commission. What set Archegos apart was not just its size but its method. H. Wang built a portfolio built almost entirely on total return swaps and other derivative contracts that let him amass long positions in a handful of high-profile stocks, such as Viacom CBS, Discovery, Baidu, and the Chinese electric vehicle maker, NIO, without actually owning the shares. The swaps amplified his buying power, letting him control billions of dollars of equity with a fraction of the cash on hand. To outsiders, the strategy looked simple: ride the upward momentum of blue-chip media and tech names while the banks that funded the swaps earned modest fees and interest. To insiders, it was a high-stakes game of leverage that hid the true exposure behind layers of legal contracts. The ascent was meteoric. By 2020, Archegos had accumulated positions that, on paper, were worth more than $30 billion. The firm's portfolio grew in tandem with the rally in media stocks, and H. Wang's reputation as a master of conviction investing attracted the attention of banks eager to earn swap fees. Credit Suisse, Nomura, Morgan Stanley, and several others became the primary lenders, each extending credit lines that collectively dwarfed Archegos' actual cash reserves. Yet, because the swaps were collateralized, the banks believed they were protected. If the stock prices fell, the collateral would be called, and the loan would be covered. Warning signs began to surface long before the catastrophic unwind. Analysts noticed that the same handful of stocks appeared in multiple bank swap books, creating a concentration risk that the industry's own risk models were not designed to capture. The use of prime brokerage accounts, which allowed Archegos to borrow shares without public disclosure, meant that regulators could not see the true scale of the positions. Moreover, internal memos at several banks revealed concerns that the margin requirements were insufficient given the rapid price appreciation of the underlying equities. Yet the lure of fees and the belief that H. Wang's track record would keep the position safe led many institutions to overlook the red flags. The tipping point arrived in late March 2021. A combination of earnings disappointments, a shift in streaming service subscriptions, and a broader market correction caused the share prices of Viacom CBS and Discovery to slide sharply. As the prices fell, the collateral that backed Archegos' swaps eroded. The banks, bound by their contractual agreements, issued margin calls demanding additional collateral. Archegos, operating with a private office structure, could not meet the calls without liquidating the very positions that were under pressure. What followed was an unprecedented cascade. Between March 11 and March 16, the four main lenders, Credit Suisse, Nomura, Morgan Stanley, and UBS, began to unwind their exposure, selling off the shares they held on Archegos' behalf. The sudden flood of stock onto the market drove prices down even further, triggering additional margin calls in a vicious feedback loop. Within 5 trading days, the value of Archegos' holdings collapsed by more than $20 billion, wiping out the equity of the family office and inflicting massive losses on the banks. Credit Suisse alone reported a $4.7 billion hit, the biggest single-day loss in its history, while Nomura and Morgan Stanley each took multi-billion-dollar write-downs. The aftermath was a wake-up call for the entire financial system. Regulators worldwide launched investigations into the opacity of family offices and the reliance on total return swaps as a backdoor for leverage. In the United States, the Securities and Exchange Commission announced a review of prime brokerage practices and the reporting requirements for large, privately held investment vehicles. In Europe, the European Securities and Markets Authority urged member states to tighten oversight of derivatives used by non-registered entities. Banks scrambled to tighten their risk frameworks. Credit Suisse overhauled its prime brokerage division, tightening margin requirements and limiting the size of single-client exposures. Nomura instituted a single-client concentration limit that caps the percentage of total risk any one client can represent. Morgan Stanley introduced more stringent stress testing for swap-based positions, ensuring that extreme market moves would trigger automatic collateral calls well before a crisis point. For Bill H. Wang, the fallout was equally dramatic. He was arrested in March 2022 on charges of fraud and conspiracy, facing a potential prison sentence that could extend beyond a decade. His family office was forced into liquidation, and the once glittering reputation of a visionary investor was replaced by a cautionary tale of hubris and opacity. Yet some of his former allies argue that the collapse also exposed a deeper problem: the regulatory blind spot that allows family offices to operate with hedge fund-level leverage without public scrutiny. Subscribe to The Collapse for more stories like this.